Hi there, my name is Greg Laxton and I'll be highlighting a few key aspects of the 2018 year-end results of Old Mutual Limited. The group is currently trading at an approximate 15% discount to its group equity value of 2,575 cents per share. We feel that downside risk is limited at the current valuation multiple, and improved capital management with excess capital being returned to shareholders is likely to justify an improved multiple going forward. The group is targeting a return on assets of around 17.4%, and they achieved 18.6% for the 2018 financial year, therefore beating their target. The managed separation and subsequent exclusion from large developed market indices are likely to explain the current discount. As a result, the next 12 months may provide significant room for re-rating relative to the rest of the insurance companies. The potential special dividend from the proceeds of the Latin American businesses could support a yield of 5% for 2019. The share price is likely to be supported by the share buyback program. And while the group faces the potential threat from new entrants into the insurance markets, they should be less impacted than the likes of MMI, thanks to the group being the biggest player in the market and through the use of Old Mutual Finance. Significant progress has been made in reorganizing the operations in Eastern Africa, and GDP growth is expected in both the East and West Africa regions. The group has less than 10% of the unsecured lending market, which provides a significant opportunity to drive future growth. Management is focused on growing Advance's loan book while ensuring responsible lending and managing credit losses. Results from Zimbabwe will be ring-fenced from 2019 to ensure customer and shareholder value is preserved. The group's entry-level transactional and lending products are advantages over its traditional insurance peers, while strong branding will assist in defending its position from the banking peers. The group has a weighting of 1.8% in the Capped SWIX index, and we maintain our overweight recommendation. Premium income was up 10% to 72 billion rand due to the increase in gross insurance premium revenue. Investment income dropped significantly to 37.8 billion rand due to the 78% fall in non-banking investment revenue to 20.5 billion. Total expenses were down 40% to 101.98 billion, thanks to lower benefits paid and a change in investment contract liabilities from negative 30.36 billion to positive 5.86 billion. Adjusted headline earnings were down 11% to 11.51 billion and down 12% to 239.1 cents on a per share basis. Diluted earnings per share of 778.1 cents is significantly different from the adjusted earnings due to the inclusion of profits from disposals of subsidiaries and the investment return on discontinued operations. The embedded value grew by 93% to 2,575 cents per share, and the IFRS net asset value was down 16% to 1,620 cents per share. The final dividend was 72 cents per share, resulting in a dividend yield of 3.3%. The group solvency ratio at 170% improved by 10 percentage points from the previous year, and this is within the optimal target range of 155% to 175%. The free surplus generation from operations amounted to 6.86 billion and is enough to cover dividend payments. The group is currently trying to simplify its balance sheet, and the aim is to drive cash generation to create flexibility for future investments and or further returns to shareholders. The actions taken to address the mortality experience will have an impact on the results in the second half of 2019. Should the subdued market conditions persist, then management expects the alternatives operations to experience some limitations around deal flow and fundraising. The insurance division is likely to experience headwinds if a normalized claims environment returns. Uncertainty in Zimbabwe is expected to remain, while the peace treaty signed in Sudan should boost economic growth. The weak SA economic environment, along with fuel price increases and the higher VAT rate, have adversely impacted disposable income and, as a result, consumer acquisition and retention. The group targets a return on NAV of approximately 17.4%, cost efficiencies of R1 billion by the end of 2019, and results from operations growth of the compound annual growth rate of nominal GDP plus 2%, to name a few. The group met the first two targets in 2018, but saw results from operations decline by 4%. The group solvency ratio target, dividend cover target, and insurance underwriting margin targets were all achieved in 2018. Before I end off, if you would like to trade, then please contact our trading desk. Investors are reminded that they can refer to our online trading platform, which contains an in-depth analysis of Old Mutual's 2018 year-end results. For more information on how to interpret a trade idea, visit the events section on psg.co.za to access previous trade ideas and how to understand the method of analysis we use. Lastly, I'd like to bring your attention to the following disclaimer. Thank you very much.